Today's market rally, it followed the release of a new plan by European leaders to recapitalize their banks and perhaps bring a halt to the sovereign debt crisis. All right, let's find out how investors should interpret all these developments. In other words, what should they just do with their money? My guests are Dennis Hynes, Chief Market Strategist, RW Pressprich, and Bob Gelfond, the founder and Chief Executive of MQS Asset Management. Gentlemen, a pleasure. Dennis Hynes, start with you. You have been saying sell the rallies. If prices of stocks go up, you've been saying take advantage of it and go ahead and sell the stocks in your portfolio. You continue with that strategy?
I continue with that strategy. I'd like to give just a little short recap on some history here. What happened on Monday changed things at least temporarily. On Friday, we were telling investors, aggressive investors, to sell a rally on a failure not to pierce the 50-day moving average. Market traded to 1170, rejected it. We looked very prescient. Okay, then on Monday...
That's a fancy word for smart. Go ahead, take it.
No, okay. In any event, what happens on Monday, which is what the market does to you, we had this huge rally. Looked pretty stupid after Friday's forecast. Now,
but were you selling on Monday as the stock market increased in value?
I was selling today. Okay, selling today. And very quickly, let me tell you what happened on Monday. You're not old enough to know this, Pimm, but when in younger times, when the Japanese owned the world, they bought Rockefeller Center, they had Pebble Beach, the whole thing. Their currency was the only place that people went for safety. What they would do is they would use holidays to punish those long speculators. They would come in on Columbus Day, they would sell the currency, it would just destroy those speculative longs. The Germans and the French did exactly the same thing on Monday. They announced a plan which was to come at the end of the month, which is an eternity in our market. And what that did was caused a huge short covering rally. We went easily through the 50-day moving average. It was a sham, and today's close proves it.
Bob Gelfond, you heard what Dennis Hynes says. He's taking the rallies and he's selling them. Given your perspective, let's start with Europe. Is that something that investors should be mindful of?
Absolutely. Europe is still a very dangerous place. It's still unclear exactly how the situation is going to play out. Ideally, what I'd like to see is Greece go into some sort of default. I think
you want to see a default.
I think that would be helpful.
Why is that?
Well, we have this overhang. The markets are essentially pricing in a default, and I think it's important for the authorities to recognize the reality and say that not every sovereign debt is guaranteed to be paid off. If that changes and reality is faced, I think that'll be a good thing for the markets. I think the markets would like to see that taken out of the picture. Second thing I'd like to see happen, which I think is much less likely, is if the authorities, European authorities, would let some of the weaker European banks fail. Again, it's the same thing. You got to face reality. The whole problem in Europe is a sovereign debt crisis. They can't keep borrowing money from the few healthy countries and backstopping and throwing good money after bad, the bad credits there. So let's face reality. Let's face it as soon as possible. I don't think they're going to do that, unfortunately. Let's see how close to that they get. But until that situation plays out, we're left with this tension in U.S. markets where we could possibly be infected if Europe really does blow up. On the other hand, things here are okay, not great, but not falling off a cliff either. We'll see, what happens with the profit forecast.
Dennis Hynes, this idea of a controlled default as it relates to Greece and some of the banks in Europe, if that were to happen, would that be a good thing for stock investors?
I think what Bob said was a very important thing. It's the resolution of uncertainty. Right now, we have no clue. We need to accept. Everyone knows that Greece is incapable of paying back its debt. So please let them fail. Let them stay in the euro, however. I'm not sure that I want to take the chance of letting banks and everyone else fail simply because the cataclysmic result might be more than we can bear. I just always harken back to the Lehman mess and the AIG right after that. I'm afraid we have those
one of the points that was made today, I was reading a report that it was not the collapse of Lehman Brothers that accompanied any kind of increase in the credit default swaps, the pricing of insurance on U.S. government debt. It was the movement of the U.S. government in to save all institutions afterwards. It was the admission that the government was there as the backstop. That's what got the market.
I believe that's correct, but I also believe that what happened was they said they were going to let the banks, in this case Lehman, fail. Then they recognized that they didn't have control of the situation because the AIG came in right behind it. They said, oh, God, we're absolutely wrong. I'm afraid we made a mistake. And so you're correct with that.
So you're worried about the lack of control if there is a
because
default.
there's an AIG right behind of a bank failure. We have Dexia and we have other people. Once they're one, the domino effect is something which is beyond our control.
The domino effect in Europe, that's interesting. We're going to talk more about it. We've got more with Dennis Hynes, RW Pressprich, more with Bob Gelfond, MQS Asset Management. All Bob Gelfond, this war of words right now over the Chinese currency, I mean, is there any debate that China's currency, which is pegged to the U.S. dollar, is artificially low in value?
I got news for you. Every currency is artificially manipulated at the central bank. You don't think what the Fed is doing is manipulates the dollar? I mean, the one good thing that we've had going the last few years is that we've had relatively free trade. We haven't made advances. It's too bad that these free trade agreements with Korea and Colombia and Panama haven't passed yet. But the last thing we need now is to reverse tracks and start to close up trade. It's an exact repeat of what happened in 1929 when the Congress signed and passed Smoot-Hawley, a tariff on trade. It's a source of growth, a source of dynamism that we need to maintain.
But let me just push you back on this a little bit. This idea that, you know, trying to enact some kind of tariff wall against cheap imported goods, wouldn't that save U.S. jobs? Haven't we just exported jobs away because people in places like China and India are willing to work for a lot less than U.S. workers?
Well, those cheap imported goods would be good news for those people who are unemployed, people on fixed incomes, having them pay less for goods that they need. It's the same thing as if the Chinese government were to send them a check, each American a check for the difference. I think that's a good thing. Yes, the Chinese, Indians, other countries, they do work for much lower wages, but their productivity is much less. We need, as a country, in order to advance our living standards, we need to become more productive and go up the scale of value-added goods that we produce. Trying to compete on labor with the Chinese and other low-wage laborers around the world is not how we're going to raise our living standards.
Dennis Hynes, when investors take a look at the possibility of trade wars, as Bob Gelfond describes, what should they be doing with their money? I mean, should they be investing in companies that are basing their manufacturing business outside the United States? Is that a theme?
Well, the problem is trade wars are absolutely terrible for markets. As Bob mentioned, the Depression was protracted simply because of trade wars. You can't do that. It basically causes everyone to just pull in, protect themselves, and it hurts everyone. The problem we have is that we all want weaker currencies, especially we're trying to build our export economy. The problem is people like Switzerland, when we try to have people run to a currency for protection, for safety,
like the Swiss franc
and the Japanese yen, they protect it. And as a result, no one's left to protect, no one's there for safety except America.
So why should the United States continue to take it on the chin?
Because there aren't other alternatives, and we are an exceptional country. But we do things that other people don't do. Self-interest, other countries take care of themselves. We have universal interest at heart. However, what's happening now is because people are running to the currency, our currency, it is defeating the purpose of the export economy. As a result, now you have talking heads saying we need to call China a currency manipulator to get them to strengthen their currency. So some of this has to do with the universal bid for the dollar, which makes it impossible for our exports to increase.
Bob Gelfond, has the connection between the Chinese currency, the renminbi, the yuan, with the U.S. dollar, has that peg helped the Chinese currency in a way? Because notwithstanding recent events, the dollar has been declining in value against many of our trading partners. De facto, that means that the Chinese currency is declining in value, too?
Well, they also have higher inflation there than we have here. So in real terms, their currency starts to strengthen, even though in nominal terms, the change isn't as dramatic. But you know, the point is that central planning doesn't work for the Chinese, doesn't work for us. Yes, their economy is doing very well, but I think it would be healthier for them if they didn't have so much intervention. It causes problems for us. But of course, because of that intervention, they're the ones who are buying up all the debt that we're issuing. So maybe if Congress, instead of worrying about currency bills and going after China, maybe if they cut some of the spending, they wouldn't have to worry quite so much about this problem.
Dennis Hynes, China and the import of copper, right? A proxy for in some kind of industrial activity. Do you think that we're going to see China grow at, what, 8, 9%? And should the price of copper and other industrial products go up?
They always will. As long as China and Brazil are the engines of growth, you'll see commodity prices going higher. Now, commodity prices are off their record highs, but these are record highs. So, yes, I think what you're finding is that there's a bit of softness coming into the China market and the emerging markets in general, which in fact will explain why perhaps third-quarter earnings estimates may have to diminish, simply because the emerging markets and people like GE and various other people who earn so much of their income from the international world will find that diminished. But nonetheless, if China falls back to an 8 or 9%, that will put upward pressure on commodity prices, certainly including copper.
And still sell the rallies in stocks?
Still sell the rallies. Look for places to buy gold.
We'll look for places to buy gold. And Bob Gelfond, you're still worried about Europe.
Diversified.
Stay diversified. Stay
really
nimble.
diversified.
Really diversified. All right, well done. We underline that. Thank you very much. Bob Gelfond, MQS Asset Management. Dennis Hynes, RW Pressprich.